Hello everybody, welcome to Trader User Group video educational series. This video is going to be on option Greeks. At the end of the video you should have a basic understanding of all the various Greeks and how each of the Greeks affect option pricing. At a minimum you should have at least viewed either the option basics part 1 and part 2 of the Trader User Group video series, educational video series, or have a basic understanding of options before we get into this video here. Before we get started, everybody should be aware that trading securities involves high risk and the loss of any funds. And any investment information or ideas or educational topics provided by Trader User Group not only may not be appropriate for all investors, but is provided here just for educational purposes only, and we have no liability should you decide to make any investment decisions based on the information or techniques provided here. Having said that, and we got the basics out of the way, why don't we jump off into option Greeks. For the next hour or so, we're going to spend some time on option basics. We'll do a very brief review. Again, I will make the assumption that you have a fairly good working knowledge of option basics. Option pricing and option pricing theory, we'll touch on that briefly, and then from there we'll go into the option Greeks. We'll describe and define the option Greeks, then we'll go into each of them, from delta and gamma and theta and vega, rho, interest rates and dividends. And of course interest rates and dividends aren't considered an option Greek, but they do go into pricing, and they do have changes in either interest rates and or dividends can affect option pricing, so we've included it in this educational video. And then of course at the end we're going to summarize what we covered here and their effect on option price and the underlying security. It'll be a nice little summary for you. So let's have a quick, just an option basic summary here for everybody. First off, there's long calls. Everybody understands that there's calls and puts, the two basic types of options. And when you say you're long a call, that means that you're actually buying a call, which means you have rights, which means that your expectation is bullish. And of course, if you buy a put, again, it's a debit trade, meaning you pay to play. And again, you have rights, but your expectation with a put, if you're long a put, is that you're bearish. And then we can take the counter trade to being long a call. We can go short a call. Now, when you're short any option, you have obligations. You don't have rights, and you're obligated to sell if you're short a call. Your expectation when you're short a call is bearish. But of course, when you short a call, it's a credit trade, meaning you get paid to play. Now, when you take a counter to a long put, it's a short put. And again, because it's a short option, or you're taking a short position in an option, you have an obligation and not a right. Here you have an obligation to buy in the put. Okay? And your expectation is bullish. And again, because it's a short position in an option contract, it's a credit trade. So you get paid to play. So these four basic positions really comprise everything that you can do with an option contract. You can go long or you can go short. If you go long, you have rights. And those rights can or cannot be used. It's up to you, the option buyer. Now, if you're long calls, and of course you're bullish. And if you're long puts, you're bearish. But either one of them, you have to pay to put the trade on. No margin in your account is required to do that. The most you can lose when you go long a call or long a put, the most you can lose is the cost to put that trade on. Now, when you're short, whether you're short a call or short a put, again, you have obligations. You have no choice in the matter. And when you're short a call, you're obligated to sell. When you're short a put, you're obligated to buy. And again, with a call, your expectation is bearish. unlike being long a call where your expectation is bullish. And it's a credit trade, whether you're short a call or a put, meaning you get paid to play. However, you can lose more than the actual premium that you take in when you put on this credit trade. So both with a short call and a short put, your brokerage account is going to require that you put margin up to make that trade. And other additional educational video series that Trader User Group is going to put out, we're going to go through specific strategies of option trades and how they can be utilized, and we're going to take a pretty good look at credit trades and how they can be useful as part of your trading repertoire. And then of course, typically when you talk about options, you have an option class, which would typically be what the underlying is. In this example, it's Microsoft, but it could be IBM or any other underlying. And we learned that options are traded on 3 different types of underlying. You can trade them on equities, stock basically. You can trade them on indexes like the OEX or the Dow or the S&P, or you can trade options on futures. So any underlying of those 3 types have options, but not all stocks have options. You have to check to see which stocks do have options that you can trade in. An option series in this case would be May 65 calls. The calls, and then the expiration month would be May, and then the strike price would be 65. And understand, because you can go long or short with an option trade, when you initiate an option trade, you can buy or you can sell. So when you initiate any option transaction, as you can see, you can buy to open a position. And if you buy to open a position, then you have to close. You have to sell to close that position. By the same token, if you sell to open a position, you have to buy to close that position. So with option contracts, the really cool thing is you can take a long or a short position. And it's very important that you understand the difference between rights and obligations. Later on in our video education video series, as I mentioned earlier, when we go through specific option strategies, we'll bring these back to the forefront. Let's talk a little bit about option pricing theory here. Option pricing is based on a mathematical formula defined as defined in the Black-Scholes model. There are other models that are out there, but just understand that whichever model you use, they're going to create a price for an option that's within pennies of each other. I typically use the Black-Scholes model, but it doesn't really matter. Again, the pricing is very close. There are 6 components that go into an option price. Underlying security, of course, is probably the primary driver of the option price, along with strike price, time left until expiration, volatility, interest rates, and dividends. We're going to talk about these. The market price is then used to back into the current underlying market volatility. Hence, it's called implied volatility. So what market makers do is they insert the underlying security price, the strike price, time left until contract expiration of the option contract, interest rates, and dividends. All those are known. And then what they'll do is they'll work backwards at the existing current price of the option contract until the volatility equals the current option price, and that tells you what the implied volatility is of the contract. That's how the word implied, or what the word implied means when you're referring to volatility. And the option price itself is composed. We learned that it's composed of 2 primary values: intrinsic value and extrinsic value. So understanding both long and short option positions, whether it's a call or a put, understanding obligations and rights as a put buyer or a put seller, and understanding how to calculate intrinsic value of an option versus extrinsic value of an option is very important as you continue to expand your option education. If some of these are new to you or foreign to you, you don't quite have a handle on it, I'd suggest you go take a look at Options Basics Part 1 and Part 2 in our video series, and it'll help you out tremendously. Now, all of these factors, because they go into determining an option price, an option trader must be concerned with them, obviously. If you're going to trade something, you got to understand what's going to make that price go up and go down. So you're going to be concerned, obviously, with the underlying price, time, volatility, interest, and dividends. You're going to understand how these all work together to derive an option price. And then finally, we talked about option Greeks. And with option Greeks, with an option window here, we talked about the P&L graph. And what a P&L graph does, and you'll become intimately familiar with a P&L graph. You have the x-axis going across the middle here, and then you have the y-axis up here. And you can see with the y-axis, there's a positive sign where you're showing profits, and then below the 0 line, there's a minus line where you're showing losses. So anything up here obviously is a profit, anything down here is a loss. So we learn that if you are long stock, meaning you're a buyer of stock, the graph looks something like this. So for every dollar it moves up in price, you gain $1 in profits. And we also learn that if you're short stock, then it's going to look something like this. For every dollar the stock goes down in price, you gain $1 in profit. And then of course we also went through very briefly calls and puts. With a call, if you're long a call, do you remember how that option P&L graph looks? It looks like this. Essentially, this amount right here is what it costs to put that long call contract on. And then once it hits the break-even point right here on the graph, then you make money like stock. Because you're leveraged, you make money percentage-wise a lot faster than you do with stock. Now, a short call is almost a mirror image of that, but it's, the opposite. A short call looks like that. Again, the profits, as you can see, are limited to this amount right here. It's not unlimited profits. You're limited in your profits based on what you sell that call option contract for. But notice down here, it's unlimited as to losses. The higher the stock price goes up, the more that you can lose. And then of course we have puts. If you're long a put, do you remember how that contract looks? Looks like this. The more the contract goes down in price, the more you make with a put because you're bearish. But again, you're limited to your losses. You're limited to your your losses based on the cost of this long put when you buy a put. This right here is the price you paid for the put. Here's your break-even point right here. And then once the put reaches your break-even point, once the contract hits your break-even point, you're making more money. And then if you're short a put, does everybody remember what that graph looks like? If you can graph that out in your mind, it looks something like this. As a short put, you're limited as to how much profits you can make. Right here, this is the amount of premium you took in when you sold that short put. But remember, with losses, you're unlimited essentially all the way down to a zero price with your underlying security. So with short positions, you have unlimited liability, and profits, you're limited. But we'll look at some option strategies where that kind of scenario makes sense. With long strategies, you're limited as to what you can lose, basically to the cost of the contract, but you're unlimited as to the profits that you can make. Let's now talk about the Greeks. Now that we got some option basics out of the way, let's take a look at some Greeks here. What are they, by the way? Well, Greeks are a statistical reference that's calculated using the option pricing model. And what they do is they measure an individual options contract to sensitivities in the changes to the component variables that affect that option pricing. And we've gone through them before. You know, the underlying security. We talked about time and the option expiration. We've talked about volatility. We've talked about interest rates. We've talked about dividends. All of these go into the option contract. Well, Greeks measure that. Greeks measure the underlying, the strike price, time to expiration, volatility, dividends, and interest rate. The only constant in all of this that does not change, do you remember? Do you remember what the only constant in 1 through 6 is that does not change through the life of an option contract? It's option strike price, number 2. That's the only constant. The underlying price naturally changes. So does time to expiration. So does volatility. Dividends can change, and so can interest rates. Strike price does not change. But these 6 components are used to determine risk on an individual contract. You can use these in option Greeks basically to look at your risk across an entire option across your entire portfolio. Let's talk about delta for a minute. As you can see, delta is drawn by what looks like a triangle. That's the Greek symbol for delta. Delta can be defined 4 different ways. First way is a rate of change of an option value relative to a change in the underlying. By the way, we're going to talk about each of these areas. The second way that a delta can be defined is the derivative of the graph of an option value in relation to the stock price. And although it's a mouthful, it's pretty basic and simple, and I'll show you what that means in a minute. Another way that delta can be defined is the equivalent of the underlying shares represented by an option position. This is kind of known as the hedge ratio. That's a very important use of delta, and it's going to be part of your repertoire as you start learning more about trade adjustments later on in other educational videos. And then the estimate of the likelihood of an option expiring in the money is the final and fourth use of delta. So why don't we take a look at each one of these in a little bit more detail. Before we do, delta is probably the most watched and common Greek. In the money options, as a rule, have higher delta. Out of the money options have lower delta. At the money options have medium delta. Higher, lower, and medium. How do you define what's higher and lower and medium? Well, why don't we go into that and you'll see. Let's take a look at definition 1, which is rate of change of the underlying as it relates to the option price. And I think this definition is probably the most used definition across all the 4 definitions of delta. What it does is it defines the size of the option price move when the underlying security moves $1. So let's look at an example. Here you're seeing, let's see, we've got right here, you've got calls. So let's take a look at calls as an example. And here we got a delta of 0.50. Notice it's a positive delta. The stock price moves from $60 to $61 a share. The call value increases by 50 cents. The reason why is because with a delta of 50, that means when $1 change in the stock price, you have a 50 cent or 50 cents change in the option price. That's how that particular component works. Now let's look at another example. In this example right here, we're looking at a call that goes down in price. Here you can see our stock goes down in price. Here you can see the stock goes from 60 to 59. Again, the delta is positive for calls, but being 50 cents, it goes down to 250. So it works both ways, up and down. Now keep in mind that in these examples, it was cut and dried. You know, it went from 60 to 61, so the delta went from 50 to 54, but the call value went from 3 to 350. In reality, as the price of the stock is moving in this direction, you know, 60.01, 60.02, and so forth, all the way up to 61, call delta is moving very, very gradually in the up position. Same thing that happens here. As the stock gradually moves from 60 to 59, the call delta, or the call value, is gradually moving from $3 down to 250. So it happens very gradually. But that's how delta is determined. Now let's look and see what happens when you use puts instead of calls. A couple of things I want to point out. First of all, with a put, notice that the delta is a negative here. It's not positive. All right, showing a delta that's negative. So with puts, delta is negative. With calls, delta is positive. And the reason why that is when you're using calls, your bias basically is bullish. So you have a positive market expectation. When you're using puts, you have a negative market expectation or a bearish expectation. So naturally, if a stock price goes from 60 to 61, your put value and the option contract value goes down by the amount of the delta. Here the delta is 40. So if you subtract 40 from 225, you get $1.85. That's the new price of the option. Likewise, if the stock goes down, which is what you want it to do, if you've got a put and the delta of minus 0.40, then what you do is you add the delta to this, and you've got a larger delta, or rather you've got a larger option put contract. So with puts, you can see here that you have a negative delta, but it increases the option contract size. Now, the real interesting thing that some of you may have picked up is this is really nice when you're long a put contract, meaning you want the price of the stock to go from 60 to 59. That's what you want to have happen. When you're long a contract, your put value increases, meaning you're making money at a faster rate, because now your put or your delta value increases. So you went from 0.40 to 0.44. So the next dollar change down, rather than your option contract going up by 40 cents, it's going to go up by 44 cents. Okay, same thing with calls. So being long a contract works out really well for you. Now let's take a look at the next value for delta, or the next definition for delta. A derivative of an option price. What does that mean? Well, if we look at a graph, and on the bottom here on the x-axis we have stock price, and on the y-axis we have call price, and then we plot the increase here in the price of a call, you can see here that the price goes up as the stock price goes up. And mathematically what that means is, for any given point on the graph below, the derivative of this graph here will show the rate of change of the option price. So if I were to draw a line that basically touches that right there, and then draw another line that touches that right there, you can see here that this is measuring rate of change, and it measures rate of change. So much like the option P&L graph, delta measures the rate of change, and notice that as the stock price keeps going up, this curve steepens until it gets to a point where it's equal to 1 delta. And what underlying has 1 delta? They all do. So stock has a delta of 1. Index options have a delta, or index securities have a delta of 1, and so do futures contracts. Let's look at the third definition. As you can see here, underlying shares equivalent. This is called a hedge ratio. This is a very important definition of delta. In absolute terms, the delta of an option is between 0 and 1, meaning that with puts you can be negative 100 to 0, or with calls you can be positive from 0 to 100. But the absolute value always falls between 0 and 1. So let's take a call as an example with a delta of 0.60. That means that a dollar rise and the stock price causes the option price to go up 60 cents. One contract equals 100 shares. So that hedge there means you're having one option contract with a delta of 60 is the same thing as having 60 shares of stock. Let's take a look at another hedge calculation. If you buy to open 5 contracts and your delta is 0.43, that's the same thing as having 215 deltas. 215 deltas is 5 times 0.43 times 100. And that's the same thing also as having the equivalent of 215 shares of stock. So you can see you use delta to determine, well, gee, I own 5 option contracts with a delta of 0.43. What's the equivalent amount of shares I would have to own to have the same profit and loss diagram or similar to it? And the answer is 215 shares. And the final definition of delta is the likelihood of expiring in the money. And it's kind of loosely defined, but it's fairly accurate. And what that really says is the option delta projects the probability of an option finishing in the money. And let's put an example out. If you've got a delta of 0.60 or 60%, that means you've got about a 60% chance of finishing in the money for an option contract. That's why when people go really way out of the money and you got a delta of 12 or 15, you have a very low probability of that thing finishing in the money. That's why those option contracts are cheap. Again, another example, an option with a delta of 0.34, you got a 34% chance of finishing in the money. So option deltas, one of the things we learn is that they're not constant. They're based on the dynamic inputs of the pricing model, which is stock price, time to expiration, and volatility. Call and put pairs. What's a call and put pair? What does that mean? Well, that means same strike price, same option contract month. For a call and a put, you'll see that the deltas are closely correlated. And as a general rule, the absolute value of a call delta plus the absolute value of a put delta will add up close to 1. Remember, we said puts have a delta that is negative, but if you take the absolute value, that's taking the positive. So if you add them up in a put call pair, they're going to be roughly approximately equal to 1. As we get into option synthetics, you'll understand why there might be some unique differences between an American style and European style options, but essentially they'll add up to about 1. As I mentioned before, we'll describe this more in our video series on option synthetics and put call parity. And just know that options that are in the money have higher deltas. Options at the money have a delta of approximately 0.50, and out of the money options have deltas that are less than 0.50. Now, time does affect the delta. The more time left until an option expires really tells you the less certain it is whether that option will be in the money or out of the money. So what does that mean for delta? Well, that means the delta of both an in the money and out of the money options will reflect that uncertainty. So what do you think that's going to do to the delta? Well, an in the money options delta increases or will increase as expiration approaches. The further out in time you go, that means that option contract can finish out of the money as well as in the money. So the delta goes down, hence the probability of it finishing in the money goes down. But as that option contract approaches expiration, then an in the money delta will increase, hence the probability that it's going to finish in the money increases. Same thing with an out of the money option. Does that make sense, everybody? So time does have a small effect on delta. How about volatility? Does that affect delta? Well, sure, it affects delta. As volatility increases, then an out of the money delta will increase. Why? Well, because that means there is a higher probability that that underlying security is going to move up and down a greater distance. Hence, it has a higher probability of finishing in the money. Hence, the delta will increase a little bit. Same thing with an in the money delta. as volatility increases, an in-the-money delta will go down just a little bit because that decreases the probability that it could finish in the money. Okay, so volatility increase and decrease affects an options delta somewhat, and so does the effect on time. Now, as we get into option strategies, you'll see how we make extensive use of delta as we determine strategies that we want to use and what option delta we want to buy, what option contract that we want to buy at a particular delta. So having a good solid understanding of delta is very important. Let's look at the next option, Greek, called gamma, and that's the way it's written. It looks like an upside down L, but that's gamma. And what's the definition of gamma? Well, gamma is the rate of change of an option's delta. So it's kind of, you could consider gamma a second derivative, meaning it's a derivative of delta, which is a derivative of the option price and the underlying security. Gamma is stated in terms of deltas per dollar move. I like to personally refer to delta as the speed component, and I'm sorry, gamma is the speed component, and delta is the actual acceleration. Actually, gamma is the acceleration and delta is the speed. I'm choking on my water here. So as I said, gamma is the second derivative of the graph of the option price relative to the stock price. And gamma, like delta, is not constant. Of course it wouldn't be, because as the underlying price changes all the time, so does gamma. And so does delta. Because delta is changing all the time, then gamma is going to change. In the money and out of the money options have lower gamma. Any option that's at the money typically has the highest gamma. And when gamma is higher, that typically means delta is more sensitive to an underlying stock move, which is the case. Let's take a look at a couple of examples here just so that you can get a better visual of what I'm talking about here. Here we have a call. Gamma is positive. Notice that the delta is 50. We move up to 61, so naturally the option price moves up 50 cents, hence the delta of 50. But with a gamma of 4, notice that delta now is increased to 0.54, so that the next underlying move up to 62, the stock moves up $1 here, and the stock moves up $1 here. But notice delta is now 54 in this next dollar up move. Here it was 50, here it's 54. So that means that the option price is going to move up 54 cents in this dollar move. In this dollar move here, it only moved up 50 cents. In this dollar move here, it's moving up 54 cents. The next dollar move, notice it's going to move up even more. Delta moved up to 58. So as this stock price goes in this direction right here, you're going to make money at an increasing rate or an accelerating rate. That's due to positive gamma. Okay? Positive gamma is really good for a long position. Now, by the same token, as the stock moves down in price $1 and then down in price another dollar, notice your delta starts out at 50 cents, winds up at 42. So your delta is going down with positive gamma, because you subtract gamma from delta going down to 46. You subtract it as it goes down to 42. So here, as the stock price goes down in price, you're losing money at a slower rate. Notice here that the delta went from 50 to 46 for that $1 move, and here it goes from 46 to 42 for that $1 move. Gamma is constant at 0.04. It'll take a bigger move to move gamma. But what that tells you is that as you're losing money, you lose money at a decelerating rate. So positive gamma for calls is a good thing. You gain money at an accelerating rate and you lose money at a decelerating rate. That's the best of both worlds. That's what positive gamma will do for you. Now let's look at puts. Let's see what happens with puts. Now with puts, notice here that we again have positive gamma with stock going up. Got positive gamma right here. All right, because we're long a put, and when you're long a put, that means as the stock goes up, your delta is going down in price. Okay, notice you're losing money, and as the stock goes up, you're losing money at a decelerating rate, which is a good thing. Okay, for every $1 move up, you lose money, but at a decelerating rate, because your delta is starting at a 0.40 and your delta is getting smaller and smaller. So for every $1 move in that direction, meaning up with a put, you're losing less and less. Now, as the stock goes down in price, in this example $1 increments, you want it to go down with a put, a long put here. So notice your delta is getting bigger, and your gamma again is helping that. So long puts and long calls, you have positive gamma. Positive gamma helps you make money at an accelerating rate, and you lose money at a decelerating rate. Both very good things. So, and I think we touched on this just a little bit. When you're long options, whether you're long a put or long a call, you have positive gamma. Positive gamma helps you. It causes options to gain value at a rate faster and lose value at a slower rate. I mean, you couldn't have it any better. However, let's talk about going short. When you short an option, meaning you're selling an option up front, you sell to open a position, you have negative gamma. Negative gamma works against you as a short seller. It will accelerate your losses and decelerate your gains. Remember, most people are traders who take short positions or premium sellers. As we get into our strategy section, you'll see what I mean by that. So credit traders take on negative gamma, and negative gamma, you've got to be very good at managing your exit positions, or you're going to lose 5x, 5 times your profit potential, which is just the premium you take in on the beginning trade. Let's take a look at theta. Now, theta is really important also to a credit trader or someone who goes short. Let's talk about why. Option prices are broken down into two components, intrinsic and extrinsic. And as you know, intrinsic is easily measurable because it's that part of the option contract that if it were to expire today is in the money. Extrinsic is considered the time value, or the premium paid over parity for an option. Now, the decay in an option value is because of time passage. All options decay in time down to the parity of the option, or down to the in the money component. And what measures this decay is theta. Long options have negative theta. So if you go long a call or long a put, you're going to find that option contract price going down just a little bit every day. The amount that it goes down every day is measured by theta. However, if you're short options, remember what we said about short with gamma. You have negative gamma. Well, one of the things that's nice about a short option contract is you have positive theta. That means time decay works to your advantage. You want time decay as an option seller. You want that option to decay so that you get to keep all the premium. Anytime interest rates are above zero, which is most of the time, except for the past 2 years, of course, call theta is higher than put theta. And we're going to talk about that when we get into option synthetics. At the money options have the highest theta. Only options extrinsic value is subject to theta. Now, this is something that's very important. A lot of new people that are new to options tend to go out and buy cheaper options. And when you buy a cheaper option, that means almost all of the value, if not all of it, is out of the money. Which means almost all of it, if it's all out of the money, it's all extrinsic value. And what does that mean for theta? That means it all decays. Options that are in the money, the intrinsic value is not subject to theta. So one way to control theta is buying a deeper in the money option contract with higher delta and more in the money. Higher volatility also increases an option's premium. If you're long an option, then the option premium goes up. And if option premiums go up, then you have higher theta decay. So as volatility rises, your theta decay will go up. Now, one thing about theta is it's not constant. It's nonlinear. Like the option Greek delta and gamma, theta is not constant. Remember, the only thing we said that was constant that we talked about was strike price. Everything else changes. It's like herding cats. Some are going up and some are going down. Theta is not constant. It's nonlinear. Now, what do I mean by nonlinear? Well, the higher the intrinsic value, the higher the theta. But nonlinear looks something like this. If you've got a graph here, and you can see here when you're 75 days out, this line here represents theta decay. This right here is the extrinsic value of the option. Not the intrinsic, but the extrinsic value only. From 75 days to 60 days in, notice there's very little, it's almost flat line as far as option theta decay. It goes down slightly, but not much. From 60 days to 30 days, now you do have some option decay. Not a lot, but you've got a little bit here of decay represented on the line right here. You have this much in theta decay. But notice in the last 30 days, you have all of this theta decay right here. Hence, the option contract decays the fastest in the last 30 days. In fact, in the last 15 days here, it falls off the table. And it just really decays very, very quickly here. So what does that mean and what are the implications? Well, we'll talk about the implications of what this means when we get into option strategies. But you need to learn how to leverage theta decay to your advantage. Understanding theta is the first step in being able to do that. Vega. Let's look at Vega for a minute. Vega measures the rate of change of an option's theoretical value relative to a change in implied volatility. Now, implied volatility is the value that, as we talked about earlier, when you put it in the pricing model, it gives you the option's theoretical value, which is typically between the bid and the ask spread of an option price. When implied volatility rises or falls, the option price rises and falls in line with volatility. If you're long a contract, a rise in volatility increases the option price. If you're short an option contract, if you're short an option contract, you want volatility to fall. Okay? A call or a put with the same expiration month and the same strike price on the same underlying will have the same volatility value. Okay? Long options have positive vega, short options have negative vega. So as I said earlier, if you're positive vega, then you want volatility to increase. That's good for your option contract. If you short options, you want your volatility to decrease. And again, when we get into specific option strategies, we'll talk in more detail about the ramifications of this and how to put this in your favor. The higher the time premium, the higher the vega. And clearly the higher the time premium, the higher the theta. So the two are interrelated. At the money, options have the highest vega, since vega only affects extrinsic value. So folks, here's another Greek that only affects extrinsic value. One way, if you want to control theta and vega, is to have a deeper in the money option. If your option is all extrinsic value, then you're going to be whipsawed a pretty good bit by vega and certainly by theta. This is why, again, a lot of beginners tend to lose out on option contracts. They don't understand the ramifications of volatility or time decay. If an option is valued at 1.68 So an option is priced at 1.68 and it has a vega of 0.06. Then the following price change can occur with a change in volatility. If volatility of that underlying goes from 22% to 25%, then the option value is going to increase by 0.06 per 1% change. So here we've had a 3% change, so it's going to go up by 0.18, or it's going to go from 1.68 to 1.86. That's a 10.7% increase in the value of that option contract just because of a 3 percentage point increase in implied volatility. More likely, volatility goes up a lot more than that, as a lot of you know. Let's say volatility decreases from 45% down to 28%. What happens to your 1.68 priced option contract? Well, it decreases by 1.02. Remember, it decreases 0.06 cents for every 1% increase or decrease. Because it went down, then your or volatility went down dramatically, then your option price decreased dramatically. In fact, this decrease represents a 60.7, almost a 61% decrease in the value of your option, just on a change in volatility, assuming the underlying stays exactly where it is. So folks, besides the underlying price, vega and volatility, as I like to call it, the great white shark of Greeks, can affect the option price more than anything else. This is why it's imperative. Even if you just say, I only buy long calls and that's the only thing I'm going to do, I just buy calls, you have to know where volatility is of the underlying and of the option contract before you go in and buy a long call. And as we get into the strategy section, you'll see more specifically what we're talking about. Now, one thing I want to just quickly review, and it has to do with volatility, and I think it's important, and it's called a random walk. Now, you can see the random walk theory basically says that, in theory, stock prices are all random. Every one tick move up or one tick move down, 50% of the chance it can go up, 50% it can go down. So taking that one tick move theory, you'll see that as the ball falls down, it's got a 50% chance it can go this way, or a 50% chance that it can fall this way. And then by the same token, 50% this way, 50% that way. So just like an option price, 50% it can go up, 50% it can go down one tick. Now, fast forward this to where the ball comes all the way down. If it does the standard 50% one way, 50% the next, then the standard would look something like this, and then it would fall into the center spot. So the bulk of the balls would fall into the center channel. But for it to continually fall to the right, 50% chance, then that tells you that fewer balls are going to fall outside. Now, as we drop a number of balls through this maze here, you're going to see that it forms a bell curve. This bell curve measures the volatility of this particular movement, which, let's say it's stock as the underlying. Every stock has its own volatility, its own thumbprint. Some stocks, the price moves up and down a lot over the course of a year. It's natural. Other stocks, like utility stocks, it's a yawner. They barely move more than $10 or $15 in a year, or maybe $1 a month. They barely move. So the wider dispersion you have, the more volatility you have. Now, one thing that I want to talk about here, and we'll get to in a minute, is this dispersion across the mean, and the mean is considered the center point right here. These numbers down here are standard deviation, and what that really points out to is that this part right here, 68% of the time when this ball falls down, it's going to fall in this range right here, given this particular stock's underlying volatility. Given this stock's underlying volatility, it's going to fall that a number of times. Now, 98 or 95% of the time, it's going to fall in this range right here, given this stock's underlying volatility. So, understanding volatility, you're going to go a long way into understanding, where is this stock price going to be over a given period of time. It's very important that you know that. And this is also based on how options are priced. Now, we talk about standard deviation. It tells us not only how fast this distribution spreads out, but it also tells us, as you can see here, the probability of the ball ending up in a specific trough. As I mentioned earlier here, you've got a 68% chance of the ball ending up in one of these troughs over the course of 1 year, given a stock's certain level of volatility. You've got a 95% chance of a dispersion should the stock fall in one of these areas here. So what this is saying is, hey, I'm 95% certain on January 1st that by December 31st, that stock, and let's say it's priced right here at the moment, is going to fall somewhere in this range right here, up and down, given a volatility level for that stock. Now, every stock has a volatility level, and that's why it's helpful that you know what that volatility level is, because it'll help you plan out your strategies. Now, volatility is always changing. Sometimes it goes up and sometimes it goes down. But this volatility level will always give you ranges to play, which is what you're doing with options. You're playing these ranges. Let's take another look at another example to talk about the calculation here. Now, when you look at this, here's the calculation right here. You don't really have to worry about it too much because your software, your trading platform will take care of this. But notice on the prior slide, I said the volatility range over 1 year. Well, how often do you make an option trade or a trade on anything where it's only a 1 year trade? Your trade is likely to last 1 week or 1 day. This calculation right here will convert an annual volatility number into a volatility number based on the time frame that you want. It's price times volatility times the square root of calendar days over 365.25. You don't have to worry about it because most systems will calculate it for you in the background automatically. But it'll tell you what the volatility is of a particular stock, given a certain level of volatility. So if this stock had a level of volatility of 19.1 and we wanted to make a 1 day trade, what would the standard volatility be? Well, if you look at it and you run it through this calculation, these are the volatilities of a 1 standard deviation move and a 2 and a 3 standard deviation move. So that's saying the price range of that stock, given that time frame, this stock can range from $99 to $101. You're 95% certain that it'll finish between $98 and $102, and you're 99% certain that it'll finish 3 standard deviations or 97 to 103. Now, these prices are really important, and the reason why is when you start to use option strategies, it'd be nice to know what a typical range and probability is of these stocks so that you can price out your options and you can choose a strategy accordingly. So you're going to see that standard deviation and volatility play almost, if not a more important role in selecting selecting option strike price and option time frame as it does in just understanding the underlying security itself. Some people, all they do is just trade volatility. They don't even care about the stock price. They're just trading volatility. So it's very important that you understand volatility and how this works to be effective in pricing and trading options. And again, as I said before, as we get into specific trading strategies, this will all come into play. Let's talk about Rho. Rho measures interest rates, and it measures the option value relative to a change in interest rates. If interest rates go up, call values rise. If interest rates go down, call values decrease. Usually, Rho is the least followed Greek, and the reason why is it's measured over the course of a year. So if interest rates go up, let's say 25 basis points, well, you'd have to divide that by 4 to come up with a value for the option price, because most most Federal Reserve policy, they're going to typically raise or lower interest rates every quarter, or if they do it, it's 25 basis points here, or very rarely will they do more than that. Sometimes they do. But right now, it's just important to understand that it has a very minimal impact on options. Now, if you're a market maker or if you're trading mostly in leaps, row can have a bigger factor, but probably no more than 5% or 10% tops of the option price. Here's an example. So if a call with a row of 0.12, it'll increase 12 cents if interest rates rise by a full point. That's 100 basis points. So typically if the Feds raise the rates by 25 basis points, it'll go up 4 cents. That's what I'm talking about. Let's talk about dividends for a minute. We've already said dividends. It's not a Greek, but it's important to understand how dividends affect option prices. There are 4 key dates that you need to be worried about or just concerned about with dividends. The declaration date, and that's of course when the company formally declares a dividend. The ex-dividend date, that's 2 days before the record date, and that's typically due to stock settlement. It takes about 2 days to settle. The record date, and that's the date of record for who actually gets the dividend payment. And then the payable date, and of course that's the date that you're going to get your payment. So an example would be this. ABC Corp announces on March 31st, that's their declaration date, it will pay a 25-cent dividend to shareholders of record on April 3rd, that's the record date, payable on April 23rd, that's the payable date. So the market participates wishing to get the dividend. If you're in the market and you want to get this dividend, you must own the stock on April 1st, which is the ex-dividend date. Notice the ex-dividend date is always 2 days, 2 business days before the record date. In this particular case, April 3rd. So let's look at the scenarios of calls and puts and dividend effect. Let's assume a call that has a 10-cent dividend. Strike price is 61, a strike of 60. I'm sorry, the price is 61, the strike is actually 60. A little over a year and a half to expiration. The call value is 9.65. That was plugged into an option model. Now, if the dividends increase to 50 cents, what happens is the call value is decreased to 8.13. So as dividends go up, just understand call values go down. They typically go down by the value of the dividend itself. So look at a put. With a put with a dividend of 10 cents, you've got a baseline value of 5.42. So what do you think is going to happen to a put if the dividends go up? Exactly. They're going to go up too if you're long that contract. A put value with they're going to go up. The calls the value goes down. With puts the value goes up. Okay, so and that makes sense. When we get into option synthetics and we get into put call parity, you'll understand interest rates a little bit better, and you'll understand dividends and how they affect the price of calls and puts. So let's summarize what we've learned over this past hour or so on Greeks and how they affect the underlying. One thing, couple of interesting things that I want to point out here. First of all, if you're with stock right here, notice that stock does not have gamma, theta, or vega. The only thing the stock has is delta, and the delta of stock is what? It's 1. Okay, and whether you're positive or negative, you're short or long, it only has delta. How about puts? I'm sorry, how about calls? If we look at long calls, notice here that both your delta and your gamma are positive. And if you're, which tells you that you want, it works out well for your position. Your theta is negative and your vega is positive. If you're short calls, then naturally it's just the opposite. Same thing with puts. If you're long puts, you've got a negative delta and a positive delta if you're short puts. They're just the opposite. But one thing I want to point out here is that your positive gamma and your positive gamma if you're long a call and you're long a put. Your negative theta and your negative theta with long calls and long puts. Your positive vega and your positive vega with long calls and long puts. So what this basically means is if you're long an option contract, your gamma, your theta, and your vega is going to be the same whether it's calls or puts. Likewise, the same thing holds true if you're short a call or you're short a put. You're going to be negative gamma, okay? You're going to be positive theta, and you're going to be negative vega. So it doesn't matter where it's calls or puts. If you're short, your gamma, theta, and vega is all going to be the same. Negative, positive, negative in this particular instance right here. As we get into strategies, you're going to see strategies that are short strategies that leverage this. You're going to see that as we get into strategies, there are long strategies. All right? And those long strategies will leverage this component and this component. That's why it's important that you understand these things so that the strategies will make more intuitive sense to you. And then finally, I've got a chart here that basically summarizes the Greek effects on the underlying security you're trading. If your delta position is positive, then obviously you want your stock to rise, or you want your stock to fall in price if your delta position is negative. If your gamma is positive, you're long, so you want things to move very quickly. If your gamma position is negative, like a credit spread trader, you want things to move very slowly. If you got a positive theta, the passage of time generally increases your value. That's a credit trader. If you're negative theta, that means that the passage of time decreases the value of your contract. Okay. Positive vega, that means you're long. You want volatility to rise, which raises your value of your contract. If your vega position is negative, you want volatility to fall. And then of course rho, if your position is positive, interest rates will rise, which increases value, and if you got a negative rho, you want interest rates to fall, which decrease value. Folks, one of the things that we're going to do, and it's very important, feel free to go through this video again and again until you really understand this. As we get into the strategy section, and we're talking about specific strategies, understanding gamma, theta, and vega is going to be very important, as delta, and how it affects the option price over here. Okay, understanding these components is going to be very important for you to be a much better trader, and it's going to go into stacking the odds in your favor. A little checklist of things to check out before you get into an option position, long or short. You're going to be looking at volatility. You're going to be looking at whether you want passage of time to hurt or help, or how do you mitigate it. How about your gamma, and where's your strike price in relation to delta? Do you want it in the money or out of the money? All of these things play a very important role as you select your option strategy. Alright folks, that pretty much does it for our option Greeks overview. I hope you enjoyed it, and I hope you tune in for some other educational videos. You'll find them very helpful as you continue to expand your knowledge in options. Everybody have a really good day, and hope to hear from you again soon. Bye now.